awkward at the beginning of these things, but if you have questions about taxes, it's likely other people have them too. Feel free to ask some questions here at the beginning of the presentation. I've got a slide deck that we can go through, and you know, we'll poke here and there around it. We'll go through it. I'm not just going to read stuff, you know, to you for the most part. And so really at the outset, if you have questions, let's start with those and we can talk about them. I'll move through the presentation to get those answered. And then when we're out of questions, then I'll dive back in and we'll get through the whole presentation today. So let me open the floor to all of you. If you have some questions, go ahead and ask.
Hi, I do have a question. So I came across this workshop just out of a spontaneous search today. So it was pretty just out of the ordinary for me, but I wanted to join along and just get some information. So this is God sent in a way. But my question is, I am working on starting my own business with film production and things of that sort, doing some freelance work. And I'm just curious how one can kind of figure out their tax situation when they're doing freelance work. You know, how much money of the revenue that you bring in should you put towards, you know, the tax and things of that sort, you know? So I'm kind of curious in regards to that.
Sure, no problem. Yep, we can talk about that. Other folks, you're all here because you found the topic interesting. So if there's something in particular that you want, you know, you got a tax attorney here for an hour, free of charge. Glad to help out.
Hi. So I guess what kind of drew me to the workshop was when you specifically had in the description about taxes for Kickstarter. I'm looking to potentially do a Kickstarter campaign, but I know there's a lot of fees and taxes, you know, with all that. So just getting more information on that.
Great, yeah, and that's a good. Both of these are good ones to get us kicked off, and then go through a bunch of different concepts and issues. Anyone else? No. Okay. So as we go through the presentation, if you do have questions, raise your hand, put it in the chat, get my attention. We'll definitely go through a variety of different things. You know, I'm here to answer your questions. So to get us started with perhaps the Kickstarter, because it introduces a lot of good concepts for us. And let's see, I don't know if I have a slide specifically on that. I might. I don't think I do. So when we're talking about Kickstarter, and for those of you that are not, you know, super familiar with the platform, the idea there is that you propose that you're going to do this project, and it has various levels, sometimes different things that you're going to provide to your client. And then there is a funding period where people can say, yes, I want to buy this, or no, I don't want to buy this, or, you know, whatever. And if you meet your funding goal, then you're funded. And then you get a check from Kickstarter that's less, you know, their fees for you to then do all the things that you promised to do, right? And Kickstarter, like any other business, when they send you a check, is going to be reporting that to the IRS, right? So the IRS is going to know about this. So, you know, with Kickstarter, something that is very important and that oftentimes people don't really think about is the timing of the income and the expense. So if you haven't really thought about taxes before, most of us, you know, have dealt with taxes when we're working at for someone else. You know, we're getting a paycheck. On our paycheck, they take out a bunch of different taxes. And that's pretty much our interaction with taxes. And sometimes, you know, when we go to the store, depending on what we're buying, there may be a sales tax on the things that we buy, right? And that may be, you know, your only interaction with tax so far, and that's okay. So when you start going into business for yourself, or you do Kickstarter, which is the same thing as going into business for yourself, really, then you need to worry about a period of time where you have income and you have expenses. And whatever the net of those two things are, which could be profit or could be loss, you would then do something tax-wise with that, income tax. There's a variety of different types of income tax. There's federal income tax, state and local. So you're going to pay the feds, you're going to pay Ohio, and you're going to pay, say, Columbus if you're in Columbus. So what does that mean for you guys? To the person that asked the question, what are some things to think about? Well, first off, you're doing this for exposure, I'm sure, and also to build potentially a group of people to buy your product, and also to help get this particular product. Maybe it's a book, a book of artwork, a book of children's stories, all sorts of different things to get it off the ground. And then maybe you can sell that after the Kickstarter, right? So sometimes it's just for the Kickstarter thing, and sometimes it's for a longer project. When you're looking at taxes, you want the income and the expenses to come in the same tax year. So let's go through that. First, if you have income from Kickstarter, you've created a campaign, it's in November, it's in October, you're funded in December, you get a check in December, nothing else has happened because you didn't know if you were going to get funded or not, and then you were, all of that income comes to you in December. And then all of the things that you're going to do to create the things that you said you were going to do in Kickstarter happen in January, February, March of the next year. And so what that looks like to the IRS is, wow, you got like $120,000 of income in, the year that December fell in. Nice work. Give us our tax on that, right? And then the following year, you have all the expenses, but you don't have any income. And the IRS is like, oh, that's great. Maybe they let you carry it back. Maybe you have to pull that forward, and you're out all that money for the first year, right? So it's very, very important when you do Kickstarter to make sure that if you're going to do a campaign, do it like in December or January, where your funding date happens early in the year of the following year. That's when you get the money. That's when it's reported to the IRS. And then all of your expenses happen in that same year. That way you can deduct from that income. In my example, 120,000, you can deduct, hey, I had paint, I had software I had to buy, I had this and I had that. And really that 120 ended up being about $15,000 of profit for me. And that's the amount you'll pay tax on, is the $15,000, right? So for Kickstarter, that's probably the most sage advice that I can give you. It's tripped up, unfortunately, a couple of people that I've taught in the past, but we haven't talked about that. Just the timing of when you have your Kickstarter can cause you massive tax problems, or you'll go through all the rest of the content we're going to go through, and you'll be okay. You'll pay tax on the profit that you have. So great question. Hopefully I answered some of that. And then we're going to get into more of the specifics of tax in just a minute. The other question was on starting your own business, film production, doing some freelance work, and how much to estimate in taxes. This is another great segue question to what we're going to talk about, because again, most of us, our interaction with taxes have been, you go to work, you get a paycheck, and everything is taken out for you. When you do your own business, you have to be mindful of the amount of tax that you might pay at the end of the year after you have all your income, all your expenses. And we're going to go through that in the actual slide deck. So I'm going to go ahead and share my screen, and then we'll walk through it together. And again, if you have questions, feel free to stop me anytime, put it in the chat, and we'll go through that. Okay, so a couple of things. Starting out at the very beginning of this is a quick rendition of the types of taxes that are out there. We've already talked about a few. Income tax is what most of us are used to paying at the personal level when we do work for other people. But when you're a business owner, you also have some other tax types you might have to worry about. Gross receipts taxes. Ohio has one called the commercial activity tax. That's a gross receipts tax, and you may have to pay that. Other states also have franchise taxes. Anytime that you're going to be doing business for yourself, you have to worry about sales and use tax. That's the primary area that I work in, and it is an enormous problem, particularly if you're going to do things like sell on the internet, use fulfillment by Amazon services, have things on Etsy or on eBay. There's quite a bit of complexity now that has come down the pipe with states trying to get a piece of that online e-commerce, business. And so we'll talk about some of those as we get a little further on in the presentation. If you're going to have employees, you've really stepped up the amount of trouble and complexity in your life when you hire other people to be your employees. So that's one thing that often when I'm talking to people is try your best to not hire people until you absolutely can't avoid it. Have other people work for you as independent contractors. That is far less trouble than if you have payroll. Once you have employees, there's a whole nother world out there that you need to worry about, including benefits, doing withholdings of their taxes that you're then going to have to pay to the state and the like. But maybe to get us started, if you're just starting from, hey, I've got this idea, what do I do? How do I get started? You do have to set up an entity with the Secretary of State. And so how you do that, you can pick an entity type that is going to be a federal tax choice. Most people do this, which is, hopefully you can see that highlight, which is this top one, sole proprietor Schedule C. It means it's just you in business. Most of the time, if you haven't heard of this, or if you had, it's fairly easy to encounter, the word LLC. That's usually what you want to be. You want to be a state LLC, taxed as a sole proprietorship or Schedule C. That goes on your personal tax return that you may have been filing for quite some time now. 1040 is the name of the form. And so once you have multiple owners, there are a couple of things that you have to worry about. You can get into some of these questions here. How are we, the owners, going to get paid? Particularly if you're going to do a joint venture with someone, or together you're going to create a book, or together you're going to be in a band or the like. All of these issues come into play. It's really a lot to talk about, and we probably won't have time to go through it all in a detailed way with the time that we have. But I want to throw those out there as these are just some issues that come up. This limited liability is very important. That's why most people have a LLC, a limited liability company, for their business. Effectively, what that does is it allows for business expenses. It allows you some protection for your car, your house, etc. It's definitely worth trying to get set up. They're relatively inexpensive. LegalZoom has a fairly inadequate one, but it is what it is. Pretty cheap. You can do the Secretary of State registration, which costs a couple $100s, I believe. And then after you've done that, then the next piece is the IRS registration. This is called an EIN. It's like a social security number for a business. This is the thing that lets you get a bank account if you have not previously had a bank account for your business. You need an EIN before you can get one. Once you have one, it's pretty easy to go and get a business checking account and a debit card. And there's good reasons to do that so that you can avoid the IRS trying to treat you like a hobby as compared to a business. So that's really one of the first steps to do. The legal registration, that's at the Ohio Secretary of State. There's a couple of links here that you'll have available to you. But if you just search for Ohio Secretary of State and Business, there's a portal that you can go through to get your business up and running. You do have to have a unique name, so you can search to see if the idea for your particular name has been taken by someone already. If not, go in there and make sure that you secure that so that when you're rich and famous, other people aren't going to be able to steal that name and use it for themselves. Ohio doesn't have an annual filing requirement. Many other states do for the Secretary of State's office. So you are going to be able to file your federal and your Ohio and your local tax, but you won't have to worry about that one if you're in Ohio. The next step after you go through that and getting a federal EIN, a Secretary of State entity, is to do your Ohio tax registrations. Typically, you'll do that if you're going to be selling things that would be taxable. Most tangible property artwork is taxable. And so you may need to register for a sales tax account. That will prompt you to file a quarterly tax return once a quarter. Even if it's zero, they're pretty quick and easy to do. It's all online. You don't really need an accountant for this unless you've got a lot of sales in different parts of the country, in different areas of Ohio. Then you might need some help to do these, but these are totally things that you can do yourself. The hard questions are, what's the total amount of sales that you had? And then how much was exempt and how much was taxable? And then where'd you sell it? What county? And it calculates basically all of your tax for you. So sales tax is definitely something to be mindful of. The UST1, I believe that is the form. It's all online now, so it's not, you can't do a paper filing anymore. So inside of the Ohio Business Gateway, it'll show you sales tax or use tax. We'll talk about the difference in a little bit here, but yeah, it's either the UST or there's another similar named form. So once you have the Ohio Business Gateway account, though, super easy to find that. Again, small fee, $25. These aren't really punitive. They're just administrative kind of fees. Okay. So I'm going to go through this relatively quickly because I don't know exactly, where all of you are on your business. I assume that if you guys are selling in multiple states, it's through an online platform. I'm going to go through this pretty quick because there's a lot of other items for us to get through. So if you remember back in the day, Amazon was this company that was online. They didn't charge sales tax. And you're like, oh my God, great. And go to Amazon. I don't have to pay sales tax. If I go into a store over here, I got to pay tax. I can just go to Amazon. Well, they'll ship it for free. I have to wait for a couple of days, but there's no sales tax. I can get it cheaper. And that really had Amazon taking off, right? As a business entity, because they could do something for cheaper. And then they grew and grew and grew and grew. And eventually they got to the point where they had enough contacts all over the country that they had to start charging sales tax. And so now you'll notice Amazon is back to charging tax after a long time of really not charging anything. And the reason for that is this concept called nexus. This is a state and local issue. It is the same kind of issue if you were to sell things into Canada or Mexico or Europe. This same term applies to all of those issues. It's called nexus. It's just a fancy word for connections. So if you ever hear anyone talk about nexus, where do you have nexus? Which states do you have nexus? You can impress some bankers, that are going to be giving you a line of credit for your business. If you say, I understand my nexus issues. I know where I'm exposed, where I've got to file. All it means is connections. That's all it means. So what's the example? If you were to go and do a show, a big show, an art festival, a con in a particular state, you're physically there. That's enough connections for you to be liable for that state's taxes. That state wants you to collect that sales tax for them, and they want you to pay income tax there. Now, if you're not making a whole lot of money out there, that particular con or festival, everyone knows that you as a business owner have some decisions to make as to where you put your money. And if you only are going to owe like $50 or $100 out of another state, you really have to think about, is it worth me going through and spending $1,000 to do all the registrations and get all that done and then have someone file my tax return just to pay $50 or $100 to this other state? So the technical rule, whenever I talk to people about this, is if you have the connection, you're supposed to file the return, you're supposed to pay the tax. But on the other hand, all business owners go through this business risk, kind of analysis. And if you really don't owe a whole lot, you can decide to take the risk if you want. What I'll say is if you're going to be at this con every year, it's a big one, it's a huge part of your year, and you're making a lot of money, you really should consider doing the registration, even if it's not, the state you're living in. It's a really good idea. There are some places that make you do it. So for example, if you are going to sell through a state historical society gift shop or a university gift shop, something you do is so great that they decide to sell the product, many times they'll make you do the registration because they're effectively the state, that will say, you must do this or we're not going to sell your stuff. So where you need to file is, for the most part, based on where you go. Recently, the last couple of years, there was something that happened, and right here is a good link in Etsy. They have a good discussion about this. It's changed to if you make a bunch of sales, but you never go there, that's enough for you to collect the tax. That's enough for you to be subject to tax in various states. We're going to leave it there. We're not going to go, all the way into the weeds on this, but sufficient to say, if you're going someplace and you're making a bunch of money, you really need to think about, do I need to do something with taxes in those other places or not? The more money that you make in those other places, probably the riskier it is for you to not do that analysis, ask the question, call the tax department. And, if you go through your fact pattern, hey, I'm not going to tell you who I am, but here's my facts. This is what I did. Do I really need to register? They'll tell you. A little bit of homework on your end, free. You can ask people. People like me. There's another great individual in our community, Elaine Luttrell. She does a lot of great work as well in this area. You could ask one of us. So just consider that. That is an area where artists can get themselves into a lot of trouble if they're doing a lot of sales online and they have major sales in other states. It's definitely something to think about. Again, there's a couple of more nuance to this in terms of the kind of nexus that we have: income, franchise, gross receipts, sales taxes. Sales tax is really the dangerous one because it's between 7 and 10% of your gross sales, not your profit, but your top line, the amount that you sell. And that's a really high tax. Most states are like 7% of your profit. So your profit might be, a couple dollars, $200 on something that you sell that's $1,000. Sales tax is on the entire amount. So it can be really, really dangerous. That's the one you got to watch out for. Some practical advice from me: register in your home state, wherever that's going to be. If it's Ohio, great. If it's New York, great. Wherever you're based, register for all the tax types that you're going to have to pay. Income tax and sales tax are the ones I suggest, for the most part. I wouldn't register in all the places you do remote sales unless you're going there all the time and you're making a lot of money. So if you do one trade show, yeah, don't do it. But if you're going to a trade show or a con or something all the time, you really should think about, registering in that place. Okay. Quick thing about where you need to file. Most of that is all states. Everybody has to file with the feds, right? So when you have a business, you're going to have to file and report your income to the IRS. And most of the time, people are doing that on their personal tax return. There's a separate schedule. And I'm going to tell you next, well, what exactly does that entail? What do you do, right? So starting out, when we're in person, I have all this together with us and then I give it away to someone because I have the package built and I just give it to somebody in the class, but sadly we can't do that. So I'll describe it for you. Starting out, get one of those accordion folders, probably ones you've seen in like old lawyers' offices or old people's, buildings. They're brown, right? They expand and contract, and they have months on them sometimes, right? So there's a slot for January, February, March, April, etc. Go and buy one of those. It's like $20. Anytime you have income, you make a sale. Anytime you buy something for your business, put the receipt in there. If you buy it online, print it out. If you go to a store, make sure you hold on to it. Put it in that month. That's like the bottom, easy to do. You're just stashing it in a place. And then on a monthly basis, every couple of months, at the end of the year, you'll go through and you'll put all those things and add them all up into categories. And so that might be art supplies. It might be going out and talking with people and trying to get business, and you buy them a drink, or you buy them coffee, or you buy them a dinner or a lunch or something. The raw materials for your artwork. That might be in film production. That could be physical film. It could be the equipment that you are using to create, the film. It could be all sorts of different things. The thing that I like to say is make that as broad and net as possible, because if you don't put it in that accordion envelope, you're not going to have the opportunity for an accountant or someone else who's doing your taxes to take that as a deduction for you. So if you don't put it in there, it's for sure not going to help you. If you put it in there, though, they might say, yeah, you can't use this, but nice try. So that's the first thing. Just keep everything. Put it in a folder. Keep it in, one of these Costco boxes that are all around me. From Costco, you can go and just buy something there, and then they give you this great big box. Just throw it in there, and you can deal with it later. And you see there's some examples of things that you should keep as well: bank records, canceled checks, etc. For the most part, if you've got sales by state, try to keep a record of the sales, not necessarily the expenses, but the sales into the different states. That will help you when you go and do that tax return. And so that $40 complete solution, that's what I'm talking about in terms of the package here. Let's see. Okay, question. Why do most people advise to register your LLC in low income tax states? Is this illegal or just frowned upon? So, good question. For the most part these days, state taxation is really based on where your sales are. It used to be that where your property was and your payroll, if you had payroll, and where your sales were added together into like an alchemy formula to come up with a percentage that you then applied to your income, and then that got taxed in the state. So all of state taxation for income tax basically boils down to a concoction of sales, property, payroll, mixed together in some formula that is different by state, and then applied to multiplied by your income, and then your income by the tax, and then that's what you pay, basically. Most states now have gone away from that. Most states are just going with pure sales. There are some that use the other things. The thing with that is, if you locate in Ohio, or you locate in Delaware, you locate in Florida, you locate wherever, it doesn't really matter, because those other states are going to make you pay tax based on where your sales were. Now, it is true that places like Florida don't have a personal income tax. They do have business taxes. They do have sales taxes. And so if you locate in Florida, great, you're going to be able to avoid that. But that's a pretty big life decision to be doing because of a little bit of tax savings. For the most part, where you put your business isn't that important these days, especially with e-commerce being such a huge driver of sales. It doesn't really matter. If you have a lot of sales in another state, you're going to be just as exposed as if you put your business wherever it is. It's a good question. One thing to consider on the documentation, hand scratch notes on paper are great. They're better than nothing, but it really is good to have some kind of electronic record. The bargain basement one of those is like a text document, right? Like .txt. I think they still have those. Word documents work fine. If you're on Mac, Pages, that's fine. If you can put it in Excel or numbers, that's really good, because then you can categorize things pretty easily. You could say, on the film production side, here's a whole category of this stuff. And then maybe part of that film production is, I got to buy wardrobe. Okay, wardrobe. You can put all those expenses down in categories, and that makes it very easy to then put together your tax return. It is useful to have a separate checking account or a credit card that you reserve just for that purpose, which I know is hard, but if you can do that, it makes it a lot easier, because everything that you put on that card, the checking account, debit card, or your credit card, it's all business expenses, and that's good. That's very useful. It's also something, oh, yes, hello.
Hi, I have a question. So something that we encounter a lot with individual artists, and they may have an LLC also, is they do a lot of transactions by their iPhone, by texting.
Yeah.
So can we talk about what via text would be eligible for, the right paperwork?
Sure. Great question. So, I recently was part of a Columbus-based group that was selling, doing an auction, an online auction, and it was through Facebook. And Facebook, they had a bunch of things listed, and then in the comments you listed how much you would be willing to pay, and then someone could, come after you and say, no, I'll pay more, and at the end of that, they cut it all off and they said, okay, these are the winners, right? And then it was up to the individual artist to figure out the payment structure. And so there was a lot that was kind of through, phone and Facebook message and all of that. And so, the primary thing for you to worry about when you're doing the record keeping on that is you need to have some kind of record of how much the cost of the piece was that was sold, what's your revenue, and then all of your expenses. So your expenses are pretty easy because you're buying stuff all the time and you've got receipts from your vendors or the stores that you walk into. But what about your sales? So on the sales, a PayPal receipt is fine. You can go into PayPal if that's your choosing method, or Venmo or one of the other ones, and just have all those listed out, right? And unless you're going to mix those things, like if you have a Venmo that you use for all your personal stuff, and then for all of your sales for your business, that's not so great, because then those look to the IRS like sales, right? When you're getting money from other people that split pizza with you or whatever. So I would invite you to pick a platform and have it just for business, whatever that is. It could be Square, it could be PayPal, it could be Venmo, whatever you choose. Just make sure that that particular service you're going to use for business is only for business. And then they'll have all the records that you can print out to add into your folder. So that's a great question. And
let's take it a step further though, Joe, because what we see is people will have conversations by text and maybe pay in cash.
Okay.
Right.
So, for you, if that is the situation that you're talking about it and the like, I do teach a number of classes at CCAD, and one of the classes we talk about are contracts. There are lots of contract sort of things implicated by you doing things by text and coming up with terms and figuring out and what's the handshake, where are we, all of that. It's a little beyond what we can talk about in the time we have tonight, but that certainly is a record that you'd want to use if that's all you have for this is our agreement, that's our handshake. In terms of the sales though, you could just have, a piece of paper that said, hey, product 7, $40, paid such and such. That's okay. Your sales records don't have to be super detailed in terms of proving to the IRS that they happened. The IRS is super nice in that if you said you made money, they're gonna give you that. No problem. Okay, how much you make? 100,000? Right on, man. Power to you. Good luck. How much were your expenses though? Gotta have to have the documentation or else they're not gonna let you have it. So the IRS is really solely focused on the documentation of the things you buy that you want a deduction for. Most of the time, whatever kind of record you have on sales is totally fine. Doesn't have to be super formal. So when pricing your product out, it is important. I will share with you something that I share with my students. You want to get paid for your time. You probably want to make more than minimum wage, possibly. You probably want to make more than say $2 or $3 an hour. I'm just going to throw that out there. So I do an exercise in class where I go through and I say, okay, so what were the materials cost of this thing? How much time was it? And then how much money were they making per hour? So if you look at this thing on the screen, and you may never have encountered something like this before, this is wheat, right? It is not expensive. Like the materials cost on this might be $1. How much time was involved in weaving that and like messing one up and then saying, dang it, and then throwing it away and then starting over again? So like how much time to create one of these? It's probably a couple of hours, right? And so if you're selling this thing for like $12 and it took you 3 hours to do it and it cost you $1 to make the thing, but then 3 hours. So if you're selling it for $12, that's 11 divided by 3, you're making like $3 an hour, right? And people don't sort of realize that a lot in the artistic community sometimes because you just don't think of it that way. So do be very careful when you're pricing your product that you're making sure that you're getting paid for your time. Okay, so I've got a question or two. Okay, so that looks technical. Hopefully we can get that resolved. You might try, turning on and off your mute button. Sometimes that helps to like taking out the old video game and blowing the cartridge and putting back in. It shouldn't work, but it does sometimes. Income tax deductions, really, it's anything that touches the finished artwork until it gets to the customer's hands. So as an artist that is producing a thing, a tangible thing, this is pretty easy because it's all of the materials that go into it and the paintbrushes or the scratchboard knives or whatever it is that's actually touching the product. That's a deduction. Now in film, it's really interesting because not all of the things are going to touch the actual product. And so you've got a little bit of a loose area there about what things are deductible and what things are not. And I'm going to give you an example. Years ago, this is an actual case that went to the IRS. Years ago, there was a newscaster in Columbus. And this newscaster and their accountant decided that the thing that they were going to deduct are various types of clothes and undergarments specific to this person being a newscaster and being on the news. And the thought was, well, I would never wear these things or have these particular kind of undergarments unless I was going to be on camera. And so obviously I should be able to deduct these things. And I did actually use them while I was on camera, right? So it's totally for business. And the IRS said, no. See, look, we're not going to give you a deduction for these particular kind of undergarments just because, there's no lines and whatever, because we're going to video you. That is not enough. Like it's capable of other personal use, regular use, that kind of thing can't be deducted. And that's the struggle when you get away from things that directly touch the artwork, okay? I'm going to give you an example. Give me 1 second. I'm going to go grab a piece of artwork and I'm going to show you what I mean. So this is a piece, it's an American flag. I'm going to get this close as I can here. These are bullets that form the stars in this particular product. Okay. So these bullets actually are part of the artwork, like they were transferred to me when I bought this thing. And I bought it in part because it looks cool and also because of this particular issue. But when that person bought those bullets, they shot them, right? They ran them through their gun, and then the casings they used for their artwork. And I'll bet you that what they tried to do or have done is they said, well, those, that box of bullets was $50. I'm going to deduct that whole thing because obviously it's part of my artwork. And the problem is the IRS would look at that and say, well, you can deduct the cost of the casings. You can deduct the cost of the casings themselves. So if you had 50 of these things, what would that cost? Maybe $4, $5, something like that. That's your deduction. Not when you bought the bullets whole because you use them for another purpose. So this is the difficult part about income tax deductions, is that often you've got multiple uses for them. Food is a great example of that. Everyone's got to eat. And so there's a variety of rules out there that prevent you from taking a full deduction for everything. So just be mindful of that. Whenever you've got something that you're going to buy, think about, is it really only for the business? Is it really only for the thing I'm using it for business, or it's going into a product, or did I use it for other things too? And if it's other things too, you might want to talk to an accountant or to somebody about it to see if you really can deduct it. Sales tax exemptions are different. So free piece of advice to all of you, and this hopefully is useful. When you go out and you buy something to become part of the artwork, you can buy it tax exempt because you're going to take it and you're going to do something with it. And you're going to sell that, and that something you sell is going to be taxable later, right? So if you go out and you buy these materials at an art supply store, you should be able to buy virtually all of them tax exempt. There's a form online at the Ohio Department of Taxation that lets you fill it out, and then you can buy those things tax exempt. Every business has a separate separate deal in terms of what they allow you to buy and how they take your exemption certificate. It's also something that eBay will allow you to do. So if you buy a lot of your stuff on eBay, for whatever reason, maybe it's old antiques, used things, you can give eBay an exemption certificate, and then they will not charge you sales tax when you buy those things online. Same thing with packages. So things that are going to package your product can also be bought tax exempt. So if you're going into Lowe's and you're buying shipping materials and the like, you can get a tax exemption for that. It's really just, you know, are you going to go through the hassle to get that established at that store? And if so, then you're going to be able to save on that tax whenever you buy stuff. Okay. So again, on income tax deductions, most of the time we're looking at you have some kind of other reason why you're buying this thing. Those are the areas where there's restrictions on deductions. Meals are one of those. So if you're going to be out of town, at a con, at a show, and you have someone who's interested in your artwork, and maybe they bought it before and you want to go and take them out to dinner and just talk up, that's a business expense. You get to deduct it. It's 50% deductible because, again, you got to eat. So the IRS says, yeah, it's some usefulness to you, but we're not going to let you take the whole thing. Kind of like the bullets that I had in that piece of artwork that I had purchased on the flag. We'll give you something, but we're not going to give you the whole thing. Travel can be deducted as long as you are going to a temporary place of work. So if someone hires you to do a mural or something on a wall someplace in Columbus, that travel time, absolutely, you can deduct that. The one to be careful of is when you're going from your house to your place that you go to all the time, maybe your studio or other set business location. That's commuting, and you're not allowed to deduct those miles or that travel. So, you know, just be mindful of that. You can deduct some travel, but not all travel. In order to keep track of this, at Staples or Office Max or whatever, they have these little tiny books that are mileage logs. Just write down where you went, how many miles you had, what the date was, and that's all you need. That's enough for the IRS to allow you that deduction. Okay, a couple of quick things. So most people are going to be filing April 15th. That's the deadline for most income taxes. Sales and use taxes are generally due quarterly, unless you have a lot of sales and then they're due monthly. Again, if most income taxes are looking on profit, if you have a loss, that's okay. Most of the time you're going to be able to preserve and use that in a later year where you might have profit, so you can net the two of them together and then pay less tax. So even if you have a year that's a down year, that's okay. You're still going to be able to use that in a future year most of the time. So this is the scary slide. Here are all of the taxes that you're likely going to pay. Income tax ranges from 0% to 35%. That's federal. FICA or self-employment tax. So if you are working for someone else, you've seen it as FICA. It's about 6%. If you work for yourself, it's 12%, up to $120-some thousand a year. It's 12%. State of Ohio is anywhere between 0 and 5%. Most people pay 3%. For you, there's a special deduction for business that will mostly allow you to pay 0 tax on that. Ohio CAT is $150 if you get up to 150,000 of sales, and then local ranges between 0 and 2.5%. So what does that mean? Probably you're going to pay something like 10-15% federal tax plus 12% for self-employment tax. So now we're at 10-17, right? Plus you're going to have Ohio, which is probably 0 for you, plus local, which is about 2.5 most places. So about 20. So if you are looking to look at, hey, here's my income, here's my expenses, I got some profit, what should I be like putting aside for taxes? 20% is probably a pretty good number as a guesstimate. If your income is more substantial, that number goes more to like 30% in terms of what you might want to set aside. Sales tax, again, that's a point of sale tax. So when you're out at a place, if you're taking it electronically, it's super easy. You just punch in whatever your amount is plus, 6 or 7%, whatever the rate is. A lot of those platforms will do it for you, like Square will do it for you most of the time. Okay, we're running a little short on time. I want to make sure that we have some other time for questions.
Yeah, Joe, there is a question in the chat.
Okay. Okay, so the question is, well, what if I buy like a camera? If I go out and I buy film, I understand that I can take a deduction straight from my income. So I've got, gross receipts, income of $10,000, and then I bought film, and the film was $1,000, so that's $9,000 that I might get taxed on. It's a dollar for dollar, same year you get to take it. But there are some things that you aren't allowed to take all at once, and most of the time that is equipment. Okay, when you buy equipment, more expensive, the more likely it's going to fall into these rules. You need to depreciate it over time. And what that means is that you get a deduction not all at once, but you get it over a period of years. The number of years depends on what you bought. For the most part, for all of you, there are a couple of special tax provisions that are going to let you take all of it. So for the practical purpose of our discussion, those items are likely to be something you can take the same year you buy them. Your video camera, your expensive piece of software, your new computer to do digital artwork, all of that, you're very likely to be able to take all of that in the same year that you buy it. The technical rule is bonus depreciation or Section 179, if you want to jot those down, if you're ever talking with an accountant and they're telling you that you aren't allowed to take it over, you have to take it over a period of time. Those are good keywords to throw at them. And if they're considering them, most of the time for all of you, you probably will be able to deduct all of that all at once. There are a lot of limitations on those things, including like how much money that you make and what kind of profit that you have. So it's not always true, but it is definitely something that for most of you, I would expect you're going to be able to deduct those things in the same year that you have them. But that is something to watch out for. That's not really something you have to keep in your headspace. That's something that, if you have an accountant that's helping you out, they can help manage that for you. Just a few minutes left. This is a really important one, particularly if you're just starting out, which most of you probably are, on hobby loss. And I see there's one other question. I'll get to this and then take a look at that. The danger here is that you do something as part of a portfolio career. You're just out of school. You're just starting out. You're doing food service, you're bartending, whatever, because you got to pay the bills, you got to pay rent. And then you also do your artwork and you have losses in your artwork for the first couple of years, say. That's very normal. That happens. But to the IRS, there are all of these rules that are out there that for the most part were created because rich people like horses and they like to buy horses and spend a lot of money on horses and then deduct all of those expenses from a lot of their other income. And so they've ruined it for the rest of us. So we have these hobby loss rules. Essentially, what you need to be able to show to the IRS is that, no, this is really a business. I'm running it like a business. Demonstrate your intent to make profit. You can run it like a business. Have separate checking accounts, have letterhead, have business cards, do your business records. Keep those accordion files, like I told you. Have Excel or QuickBooks or financial statements. If you want to, you can depreciate things over time on your tax returns. Those all are things that to the IRS make it seem like this isn't just a hobby, it's really a business. It's just in its infancy. It's just starting out and it has losses, and that's okay. That's not a problem. You're allowed to have that. But after a couple of years of losses, it will automatically trigger an IRS like, what's going on? And you're going to have to be able to show them, no, I'm really running this like a business. So that's very important. If these rules are triggered, what it means is that you're not allowed to take losses. So Remember when I said that if you have a loss, it's okay because you'll be able to pull that forward and use it again when you had profit. Those losses would just disappear. You would just not have them anymore if these rules applied to you. So it's very important, particularly when you're in the startup phase of your career where you're more likely to encounter losses. Okay, this looks like a long one. So hold on, let me get through it here. Okay. Questions regarding 1099. So if you have not encountered those before, a lot of times when you do work for other people, they're either going to pay you as an employee or as a contractor. The individual that's doing the film, right, that's likely that you're being paid as an independent contractor most of the time. The reporting form that is given to the IRS for an employee is a W-2, and for an independent contractor is a 1099, just a different name of a form. And most of the time, people refer to them as, are you a W-2 or are you a 1099? It's just a classification difference. If you do work for someone and they don't give you a 1099, it is possible that they still gave that to the IRS. They're not supposed to do that. They're supposed to give it to you and the IRS if they do it, but just be very careful about that. If you made income under the table, right, and you want to report that on your tax return, because sometimes whoever it is that you did that work for reported that to the IRS. So it's very important to consider that and, report that income, go back to that person, ask them for a 1099. How much did you pay me again, right? You can do that.
Yeah, before you move on from that, I just want to say, if it's okay, can we stay on? We have a couple of questions lined up in the chat. Are you okay with that, Joe?
Sure.
The other thing is, I just can't impress upon enough the weakness in the postal service right now. So if that that business were to have mailed it and maybe you didn't get it, that's very possible.
Okay, so a couple of additional questions, and then we've got time for a couple more of these questions. So I'm going to go through a couple of these since we're going to stay a few minutes after. Oftentimes when people get audited, as you might imagine at the IRS these days, almost everything is automated. No one is like leafing through all of the filings that are done. Like, I wonder who I'm going to audit today. Let's go through the list. Found one. No one does that, right? So it's all electronic. It is all based on algorithms and various things. And the things that the algorithms are looking for are unreasonably high expenses. That's what they're looking for. What's an example? Well, let's say that you're in fashion and you decide and have the opportunity to go to New York Fashion Week, in the before times or the after COVID times, you go to Fashion Week. That is expensive. You are going to have a high cost to go and do that as compared probably to what your income is. But the experience and the exposure and rubbing elbows with the right kind of people and maybe get an opportunity and, all of those things, it's not like going to Lima, Ohio Fashion Week, right? There's just an enormous difference between the two. It cannot be reduced to a dollar amount difference. They're just night and day things. They're just different. And so you may decide, hey, I got to go to New York Fashion Week. And that's a really high expense. That's probably going to get pulled by the IRS. And they're going to say, what the hell is this? You went to New York? You need to be ready to explain why you did that, why you have that expense and why it's necessary. Compare and contrast this to Joe has a continuing education requirement as a tax attorney. And so I need to go to a class that teaches me about ethics for 3 hours every 2 years. I can do that in Ohio at a cost of $200, or I could fly to Hawaii and get it out there at a cost of like $10,000 for an 8-day trip, et cetera. But I needed to go for the ethics, right? So I deduct $10,000, and they're going to look at that and say, you didn't need to go there to get your ethics. No, this is not New York Fashion Week for someone in fashion. You just wanted a vacation. You wanted to deduct it. Bad. You don't get that. So there's a difference between those two. If you have an extravagant expense, it doesn't mean that you can't take it. But it does mean you're going to have to explain yourself. And you better have a good reason for it. If it's just you wanted to go, to a cool place, that isn't going to be enough. You really need to be able to explain it. Okay. Blah, blah, blah. This is probably very useful. So if you're going to do sales tax, make sure you give them an invoice that has a line that says sales tax and the number on it. Okay, very, very important. They do have auditors that go out shopping at places to check and see if people are doing that. And then if they don't, then they audit those people. So just make sure that is the requirement. You need to say sales tax on your invoice. Okay. So let's go to questions. What if you didn't run your business this year due to COVID? What do you have to do? It's a great question. It's probably something that will face a lot of people, you know, this year, 2020, 2021, but it also happens all the time, right? You had a great opportunity, maybe you missed out on it, and so you just didn't do anything in the business. You know, you focused on other things. Maybe you had a couple businesses. You had a film related business, and then you had a scratch board related business, and the film thing didn't work out, so you did the scratch board, and that's where all of your money is. But this is still hanging out there. So if you have a business that just was dormant for a year, include it on your taxes, right? So you can have multiple Schedule Cs for multiple businesses. That's totally fine. Just say, hey, here's my film, here's my scratch board, here's my knitting, here's my whatever, right? I had this income and then I had this expenses and that's it. And if both of those are zero, that's okay. They're both zero. All of us, you know, tried our hand at baking sourdough bread in the last year, right? All of you, I know every single one of us has done it to various degrees of success. If you are one of the few that like it really worked out and you wanted to sell, and then after COVID, people were like, oh yeah, but I could just go to the store and get it. That's fine. You had the business for 1 year and the next year it was gone. That's okay. If it's permanently gone, you don't want to do it anymore. There is a procedure for filing a final return and getting it closed out. Okay. I would recommend that you do that if you are going to close it out. Otherwise, just keep it alive. Just file zeros, sales tax returns, income tax returns. You can just file zeros and then it's fine. So, all right. I think that might be all of our questions. Does anyone else?
We have one more from Donald. Would you recommend using a software program such as Quicken for keeping track of things? Any other software program you would direct a beginning artist to?
Yeah, great question. So again, the low tech, low cost model is the accordion folder, followed by accordion folder plus Excel document or numbers where you've added everything up. A step up from that is Quicken, QuickBooks Online, you know, those sorts of things. Starting out, I would say, go ahead and do one of the online products if you can, because they're cloud-based. They've got, you know, phone apps where you're out and you say, hey, I just had an expense. Take a picture and it adds it to your, you know, your expense thing for the thing, and then you can toss the receipt away. Very convenient. That might be something if you wanted to pay for it. It really is up to you. You know, whenever you're gonna have more convenience, or someone else is gonna do something you just don't want to do, it's gonna cost you more. And so you're gonna have to figure out what that is. What I'll say on that note is, if you're going through all of this, or you've looked at other you know, tax and business presentations before, and you're like, I cannot get my head around me having to do all of these things. I just want to make artwork. I want to talk to people. I want to sell my artwork. I just don't want to do this. You don't have to, right? You can outsource this to an accountant. You can even you know, outsource it at the end of the year. I mean, you know, tell them that you're going to do it, but take that accordion file and you can give it to them and they'll put everything in for you. They'll categorize everything. They'll tell you what your, you know, your income and your expenses are, and they'll do your taxes. They'll do everything for you. Don't let that be the thing that prevents you from going out and doing your own business. You know, if you really have a passion and you want to do it, you can do it, even if you don't want to deal with all of the things that we just talked about today. You do have to pay your taxes, but you don't have to do your taxes, right? Other people are available to help you with that at different price points. You know, I'm probably pretty expensive. Elaine is a great resource for starting artists. Her firm, her consulting is really dedicated to that end of the spectrum, although she handles, folks that are much further along in their career as well. Your like H&R Blocks and places like that, they're, what they are, bargain basement, kind of, what you're getting. But yeah, there is Elaine Luttrell. Wonderful person. If you haven't met Elaine, tell her I sent you, and go get coffee together. She's a really wonderful asset to the community here. Other questions?
I did have, sorry, one more question regarding when we talked about the Kickstarter piece.
Mhm.
So let's say I was planning on not doing mine, launching it in like December, January. If I did like in the spring, it would just be that now I'm split between when my expenses and my income came. And so I would be paying double on that kind of to the IRS. Is that my?
Yeah, so if you got your money, if you were funded in like December last year, then what's going to happen is you're going to have a big tax bill on assuming all of that was income because you had no deductions for it, and you're going to pay tax.
Okay.
And so let's say, just to use a number, $100,000, you're going to pay tax of $40,000 of that.
Okay.
The problem comes, and why it's so important is, okay, well, I had the 40,000 because I had 100.
Mm-hmm.
I estimated that all of the costs for me to create all the things in the Kickstarter were going to cost me $80,000. 100, I paid 40. Now I got 60, but I need 80 in order to do all the things.
Mm-hmm.
Maybe I can get some of that money back from the IRS, but where am I going to get that 20,000? Credit card? If you have that much, on your limit, good job. You're doing well. So it's a problem because of that. So that's the major issue, is that if you do it in different years, there's not much you can do about it now other than try your best to, muddle through with the cash and the whatever you have. And at worst comes to worst, you can do a payment plan with the IRS. They're kind of forced to give it to you. So you can spend that 80,000 to do your Kickstarter and get it complete. And you pay your 20,000 of the feds, and then the other 20 you pay over time, and hopefully the next year you'll be able to get a refund and it'll net itself out.
Okay, thank you. And then is it all considered income? I just read something random where it was like, if it was under a certain amount for Kickstarter that your budget, the government wouldn't consider it income. What is that?
Yeah, so everybody has a deduction for living and breathing through the year. You get a deduction for that, right? And if your income is less than that amount, you're not going to owe the IRS anyway, because you would get the deduction for living and breathing, right? Regardless of like income and expenses on the business, that's fine. But everybody gets a deduction for, just surviving for the year. That is probably the level that they're talking about, where you wouldn't have to pay tax. And so, you don't really have to worry about it. But it's a pretty small dollar amount.
Yeah.
10,000-ish is about the level.
Okay. Thank you.
If there aren't any other questions, I want to thank Joe for, again, always a really good personalized presentation for us. We will be, as long as the recording works out, okay, we'll post this online by tomorrow on gcac.org. And we have a tab that is called workshops, and we'll place it there so that others can take a look at it as well.
It's always different, this presentation, because I always get great different questions from people. The topic is so large, we could be talking for hours and hours and hours about it. So if you see another one of these come up that I'm presenting and you have new questions, come and attend, we will talk about them. And tax rules are always changing too. So you never know when the next twist is going to come up.
Thank you all for being a part of this today. GCAC is here to help you with any questions, and Joe's obviously offered to be of some guidance as well. So everyone have a great night. Thank you.
See you guys.